So, thank you all for coming. If people want to move up a little bit, they can. I first want to make an announcement. My name is Roger Berkowitz. Some of you know me, but I run the Hannah Arendt Center for Politics and Humanities here at Bard. I was asked to participate in this panel by people from the Socially Responsible Investing Club at Bard. Agreed to do so. Some of you know that the Hannah Arendt Center in 2009 had a major conference here on the intellectual origins of the financial crisis. And this panel was imagined as a place to discuss both the intellectual and also the institutional origins of the financial crisis. So the economic and the philosophical origins. And I am going to speak a bit about those intellectual and philosophical origins of the financial crisis. With me is David Matias, who's an old friend. David and I actually went to college together. He's also on the board of the Hannah Arendt Center and has been one of our most helpful and thoughtful board members. He's also an incredibly experienced discussant and practitioner of economic theory and economic practice. He has worked in some of the most important and largest financial and economic firms in the country. He'll tell you more about that, but one of his clients, one of his more infamous clients, can I say, was Bernie Madoff. And so he has great insights into what happened, and he's one of those few people in the financial world who thinks deeply about it and has written a number of papers about it on financial modeling and forecasting, on pricing inflation hedges, and has thought deeply about this. He's also the managing principal of his own firm, Vodia Capital. That's one of those words I can never get right. Vodia Capital. What does it mean, Vodia?
I took Vodia came from my Italian origins, Davio being the Italian version of David, and a Scrabble board, a couple of cups of beer, and Vodia.
Excellent. Vodia Capital. And he has an enormous amount of experience in the financial sector at Mitchell Madison Group and also at Price Cooper Waterhouse and elsewhere. We were supposed to be joined tonight by Michael Hudson, who is at the Levy Institute and also a distinguished professor at the University of Missouri. It is sad, but Michael is not going to be able to join us today. He was held up in traffic there seems to be an enormous amount of traffic getting in and out of New York that he could not get around, and he is very apologetic and could not make it. So we should still have a good time. We're going to each talk for a little bit. David talks regularly on this question, and as I said, I organized a conference on it, so we'll have each talk for a short period of between 10 and 15 minutes maybe about the financial crisis a little bit, and then hopefully have a discussion, which I hope you will participate in and enjoy. Okay. So I want to talk a little bit about what I would call the intellectual origins of the financial crisis. And when I say that, I'm opposing it in a way to the economic origins of the financial crisis. And let me be a little bit controversial and say that I think it's fairly easy to say what the economic origins of the financial crisis are. You can say it in two words: easy money. What is easy money, or cheap money, as it's sometimes referred to? It's basically the idea that money can be borrowed at very little cost, either because you have low interest rates, or you have very high rates of growth, or you have lax regulation, or some other combination of these reasons. Money is easily available, which means that you make very little if it sits in a bank account, and you make potentially a lot if you take risky investments, and thus easy money leads to investment and speculation. And easy money is, in a sense, the cause of the financial crisis. I think that's unassailable as a reason, but I think we need to ask a different question, which is, why does easy money exist? And if you actually look at what people say, because everybody says easy money is the cause of the financial crisis, well, why easy money, or what is easy money? You'll find a number of different answers. So one group of people say easy money actually was caused and started in around 2001, 2002, after the bursting of the tech bubble and the 9/11 crisis. After these two events, Alan Greenspan, then the chairman of the Federal Reserve Board, flooded the country with easy money as a way of preventing a recession, and reinflated the economy, provided a lot of money so that things could grow again, and led to more speculation, which led to the housing bubble. Another group, led by someone named George Soros, who some of you know, argues that actually the easy money era began earlier in the 1980s with the rise of something called market fundamentalism. The idea that we should get rid of government regulations and let the markets govern, and that this led to a kind of regulation-free financial innovation, which led to increased speculation and more easy money. Another more intellectual kind of group argues that actually easy money has its roots not then in the 80s, but in 1971 with the end of the gold standard. Namely that once we don't have a fixed rate at which gold can be translated into paper money, the amount of the money supply, the amount of money in circulation in the economy can grow astronomically and without limit, and this leads to tendencies towards easy money. Another group argues that it actually has its root, easy money has its root in the Keynesian response to the Great Depression after 1929, namely that once the government flooded the country with money after the Depression, people learned that in response to crises there would always be easy money, and thus there was very little risk in taking on debt, because if there ever were a crisis you would have the government come and bail you out, which leads to a kind of moral hazard. And then of course the most historical group actually argues that it has its roots back in 1716 with the formation of the Bank of John Law in France. Some of you know this, in which paper money was actually invented, or for the first time we had paper money that could stand in for gold money at a certain fixed rate. And that this would allow the amount of money in supply to exceed the amount of specie, which would allow for increasing money supply and devaluation of money. I mean, all of this is to say that while easy money is clearly the cause of the financial crisis, you can't say that it's the cause of this one, because the problem of easy money has been around for a long time. And it's also to say that the answer, namely that easy money is the cause, is not really an answer. It tells us very little. It's actually quite helpful to realize or to think about the fact that someone named John Stuart Mill, who many of you read as a political thinker, wrote a paper called Paper Currency and Commercial Distress, in which John Stuart Mill argues that cheap money will inevitably appear in capitalism and cause speculative frenzies. People will speculate money and it will create bubbles. Now, Mill writes this paper in order to argue in defense of paper money, right, against the critics. Because he was arguing at a time in which people were saying, we should go back on the gold standard. Paper money leads to bubbles and crises. And Mill said, yes, it does. But it's inevitable. And in capitalism, you're going to have boom and bust cycles. It's just part of the system, and you shouldn't really worry about it. And this is, I think, to me, the most common argument that smart commentators have made in response to the financial crisis. Namely, look, it's a crisis. We have had tons of crises over the last 300 years of capitalism, even more throughout history. And And as Joseph Schumpeter said in the mid-20th century, business cycles are not like tonsils, separable things that might be treated by themselves, but are like the beat of the heart of the essence of the organ that displays them. Namely, you're going to always have crises. Get over it. And it's just normal to have a financial crisis. Why are you guys all so upset about it? And what I wanted to say is that this smart response, right? It's sort of looking past the oh my God and sort of looking beyond the conventional wisdom and saying, look, it's just part of it, right? And I think it is a smart response. Runs the danger of normalizing what should be seen as extraordinary. Namely, here you have an enormous, extraordinary financial crisis. One that, if it weren't for the extraordinary, and let me say, there has never been, as far as I know, in the history of the world, a world governmental response to the financial crisis of 2008 like the one that we just had. I mean, never has the government so fully and aggressively responded. And never, one might then say, has the danger that the financial crisis posed to the world been so great as it was in 2008. Maybe people would disagree, but it seems to me that that's a fairly, you can make that argument pretty at least arguably, and I would make it. And I think it's actually important not to normalize this, not to say it's just another part of the business cycle. And to actually say we need to think about it. We need to not just ignore it, but actually consider and think about it. And in an effort to do that, I think it's sometimes helpful to appeal to someone like, not an economist, and in my case, someone like Hannah Arendt. I think Hannah Arendt is a very helpful guide here, even though she doesn't talk much about financial crises. But she does talk about one. And in her book, The Origins of Totalitarianism, Arendt says that imperialism, which she argues is one of the main roots or origins of totalitarianism, has its root, quote, in business speculation. Right? So imperialism, this political movement of infinite growth, of world domination, of totalitarian, of the desire to govern without limits of nation-states the world, has its roots in business speculation. Why is that? Well, her answer is that in business, in capitalist business, there are no limits to speculation and growth. Right? You can always earn more. You can always make more. And in fact, the point of capitalism is to amass as much as you can. And she says, for better or worse, that's what capitalism is. And in the realm of economics, we shouldn't question it. But what she says is, in the realm of politics, the point of politics is to set limits. Well, what are some of the basic limits? One is nation-states. And so we say that we live in the United States of America. But what happens when, in the name of profits, corporations become not corporations of the United States of America, but global corporations that have business all over the world, that have their headquarters in tax havens, that don't identify with being a member of a country. They grow bigger and bigger into these large, stateless, global octopus-like organizations, and they lose any kind of a limited, coherent sense that might allow them to be regulated. So you end up with regulation shopping, and they pit states against states, countries against countries, looking for the lowest regulation, and we lose our ability to regulate and in a sense limit the activities of these corporations. Another issue is the loss of moral or ethical limits. The more economic reasoning enters into our political culture, the more our countries, as well as our corporations, begin to think in terms of competitiveness. We hear this all the time. You know, our last president claimed to be a CEO president, and I don't think, you know, people were upset with him for many things, but in this sense, this is one of the reasons he got elected. And there's a reason that people like Mike Bloomberg and others, left and right, we have a fascination with economic presidents because we think they actually will lead to the increased competitiveness of our countries. And we're looking for people who can, you know, in a sense, support that competitiveness, which means, to a certain degree, being willing to overlook certain kind of ethical limits as well. This is in many ways rooted in the work of the German social theorist, actually economic theorist, social economic theorist, Max Weber. And just to give you a quick reminder, you know, Max Weber, who wrote his book on the Protestant ethic and the spirit of capitalism, starts off with a very basic question and problem, and it's simple, which is, capitalism is irrational, right? Why is it irrational? Because the basic human nature, Weber says, is you work to get enough money so you can have a good time, and you can live well. No one, purely on a human nature basis, works and works and works when they don't need the money. And for thousands of years, and Weber is a historian of culture, it was rare for people to keep working once they had enough money to live. It just didn't really happen. Only with the emergence of capitalism do people begin to amass and keep working and not spend it, and have this idea of the capitalist ethic, which is to save money and work without spending. And Weber asks, why is this so? Why did capitalism emerge? And his answer, which he tells in the book, is that people become caught up in what he calls rationalist systems, where they become interested in calculating and reasoning for objective goals because they don't have any other values. The old religious and moral values disappear, and the only values and measures and yardsticks are profit and loss, or reason and calculability, and the entire way we think is that life is about amassing the most success, and the measure of success we have that's objective is how much money you have. And so it becomes a game about who can amass the most success, and that becomes the only recognizable value. And it's this loss, or this hollowing out of other values besides success that is measurable, that Weber says is the capitalist ethic. And what I want to at least arguably put forward here is that is in many ways the intellectual foundations of these loss of limits that underlie the modern capitalist system, and that make possible the kind of financial crisis we had in 2008, and we're still living through today. There's more to say, but I'll let David talk about maybe potentially a different approach to this, and then we'll have a time to have some questions. So, David.
Keep track of my time.
Yeah.
I'm curious. I'm not faculty, so I need to get a little bit of a reference point. How many of you folks are econ students? Who's graduating soon? What are you guys doing after school? I know you.
Well, I'm also not an economics major, but I'm on the SRAC.
Yep.
I'm working in the city at BuzzFeed, a tech startup.
Technology?
Yeah.
Okay.
I work at Morningstar in Chicago.
Morningstar. Analyst?
Closing fund analyst.
Okay, good. Anyone here with a finance background? Does that exist?
We do have a master's. Anyone here a master's in finance student?
Or not for BS.
A BS in finance? But no one here?
The reason I ask is for context. I started working in financial services in 1986 when trades were done with a piece of paper. You write it down, you wanted to buy 100 shares of IBM. You put it into a tube. You stick that tube into a larger tube and it gets sucked. in a vacuum compression system all the way across to a trading desk. Person opens that tube, rolls it out on their desk, reads what it is, picks up the phone, calls the floor of the New York Stock Exchange. They send the trade down to the floor confirmation comes back. Person gets another phone call, they write down a piece of paper, they stick it back in that same tube, and they shoot it back to the broker. That whole process, that loop, would take 20 minutes. Today, I sit in front of a Bloomberg station. I have two computer systems. One's a trading, one's a market data. I enter the trade into my trading system. I hit the enter key. And at that moment, my Bloomberg system, which is showing all markets, all trades, all over the globe, my Bloomberg system confirms my trade at the moment I've hit the enter key. That trade had to go out of my system, out of my intranet, down the internet, down to the trading floor, get crossed, come back through the system, back to the Bloomberg, and posted globally. Instant. That is a far, far, vastly different world today than what existed 10 years ago, and frankly, what existed even 2 years ago. The financial crisis of 2008 is very much rooted in all of the topics, the issues, and the behavioral characteristics that Professor Berkowitz outlines. What I want to do is introduce the pragmatic aspects of what's happening today. And I say this from a very real perspective. The world has changed. On September 14th or 15th, I forget whatever day it was, that Lehman Brothers collapsed, 2008. Our world changed permanently. And as you folks enter the workforce, you're going to feel that undercurrent change. I mean, it's an earthquake. And it's a tsunami on top of it. What I want to put up on the board, you folks are familiar with micro and macro. Microeconomics, macroeconomic theory. Anyone here take micro? Anyone take macro? Micro? Whatever. You've taken them both. I will tell you this right now. They don't work. And if we run on videotape and start using all kinds of swear words about why it's just an effed up system. There is no such thing as a market clearing mechanism. It doesn't work anymore. And there is no such thing as perfect knowledge or perfect information. And I'll show you why. It's very simple. There are three things I want to outline. First is VIX. Anyone familiar with it? Heard of it? Can you tell me?
It's a volatility index.
Right, volatility index, exactly. The second that I want to talk about is S&P. You're going to Morningstar. Standard & Poor's, not the S&P 500, the index. I'm talking about the company. Standard & Poor's. S&P rates all debt. Folks familiar with them? Okay. Goldman Sachs, what are they rated? Anyone know offhand? They have about an A+, AA- rating. Okay. That's pretty darn good. That means the probability of default on Goldman debt is 1 in, I don't know, 10,000-ish, based on that rating. The rating on U.S. government treasury debt is AAA. What's the probability of default on AAA debt? Yeah, big donut. 0. Okay. Enron, folks remember them? Heard about them? They were rated, I don't know, AA-. 4 days before they defaulted on their debt. Then they were downgraded to BBB. Then they were downgraded to junk. 2 days before the default. The last thing I want to talk about is Fannie Mae. Anyone familiar with them? The Federal National Mortgage Association. This is the leverage. This is the leverage issue that we talk about. This is the free money. Fannie Mae fueled the real estate boom by very simply buying any mortgage that any Tom, Dick, and Harry could originate. You didn't have to know your ass from your elbow to originate, to loan money to someone. As long as you could check the box, and there are about 20 boxes to check. You know, does the person have a pulse? Do they have a name? Do you have a social security number? Does their dog have a social security number? Does the house exist? Do you think the house exists? Do you have a picture of the house? Okay, that's fine. We'll take that. Fannie Mae is a quasi-government institution. It's not actually, and this is pre-2008. and then post-2008. Fannie was a government-backed, quote-backed institution, meaning that the government allowed them to operate under loose regulations, but the debt was in fact not technically backed by the U.S. government. Their capital margin was very thin, and Congress allowed that to occur, meaning that while a bank such as Citigroup or JP Morgan needed to maintain a Tier 1 capital ratio of, say, 8%, and I'm making that up, I don't know the exact number, Fannie was allowed to maintain 4%. You start to do the math, that means they can double their leverage. They literally create twice the amount of money in the marketplace to buy these mortgages. Oh, and by the way, their balance sheet is not measured in millions or billions, but in trillions. So you start to leverage up that kind of money. And they literally owned half the U.S. real estate market. I think it was actually 2/3 between Fannie and Freddie. Freddie was the other institution. So here's the conundrum. You have these three factors that have to get absorbed into the marketplace. And each one of them contributed to the financial crisis in a way that was silent, that was perhaps unforeseen, but was devastating. And so Professor Berkowitz really outlines the tendencies that got us there in the first place. Someone had to light that match. The gasoline was already present. These are the matches, all three of them. And oh, by the way, it turned out to be a stick of dynamite. The VIX is an interesting thing. It actually comes from the Black-Scholes option pricing formula. Anyone familiar with derivative pricing models? You will be. And if there's anything that I can recommend, anyone here wants to pursue a career in finance or economics or anything to do with capital markets, you got to learn this stuff. Because unfortunately, this is the math that the market's operating today. Black-Scholes, Fisher Black, Myron Scholes, and Bob Burton, three PhDs who actually came out of, two of them came out of physics, one came out of economics. They all won Nobel Prizes for the work that they did. In 1976, or 74 initially, and then a revision in 76, they published a paper on contingent claim asset pricing. Basically, if I promise to buy something from you in the future, what is that promise worth? Or more important, is if I need to sell something in the future and I get a promise from someone else to buy it from me if I choose to sell it, what is that promise worth? Also known as insurance. Insurance on the stock market today is traded regularly, 24 hours, around the clock. I can buy insurance in case the market goes up, and I want to get some upside. I can buy insurance if the market goes down. I can buy insurance if the market stays flat. I can buy insurance if the market goes up tomorrow, down the day after, stays flat for 3 weeks, and then tanks. You know, iron condor or something along those lines. I don't even know how those strategies work anymore. The fellows who developed the math behind this, it's really interesting. It actually came out of chemistry. It came out of chemistry and something called geometric Brownian motion. Anyone here math or econometrics? Yeah?
Well, I know what Brownian motion is.
Okay. So it's not arithmetic compounding, it's not exponential compounding, we're doing geometric compounding. So you've got basically something that allows to grow like interest rates. Okay. What they figured out is that heat coming out of a test tube dissipates at a steady rate, known as your drift, with a stochastic element to it, a random event, an unknown. Right? They use that model to describe the movement of stocks. And then from there developed a dynamic hedging strategy to actually hedge that promise on stocks, that insurance we're talking about. Came up with something called the Black-Scholes option pricing model. It was revolutionary. And at the time you needed a mainframe computer to run it. Today, you can run Black-Scholes on your iPhone. And anyone armed with Excel can price out a derivative. Here's the interesting thing. VIX was a measure. So VIX is an index. And the underlying is the S&P 500, or the SPX, and it's actually futures on the S&P 500, so there's a slight difference there. Not really relevant for the discussion. VIX is typically measured as an annual standard deviation, square root of variance, and typically ranges anywhere from 10 to 25, and that's in points. But think of it as a 10% standard annual deviation, or up to 25. That's a pretty broad range. You go to 10 to 20, you got to double. You go to 10 to 25, you have to double and then add some. And in a normal market environment, it's a fairly interesting asymmetrical relationship. As the stock market goes up, the VIX goes down. As the stock market comes down, the VIX goes up. Why would that happen? This is insurance. This is the cost of insurance on something that is supposed to be drifting upwards. Why would it only spike when the market is going down? Because in theory, this is a measure of volatility. Volatility is direction agnostic. You have volatility on the upside, you have volatility on the downside. Why would volatility be asymmetrical in this environment? Any thoughts? People. Fear. VIX is known as the fear gauge. Right? Turns out when markets are going down, people get anxious. This anxiety permeates through the entire financial markets. As a result, VIX is an incredibly accurate indicator of people's fears. Yesterday, market goes down a tad. Actually, let's go back to Thursday. Market's down a tad. The VIX is actually trading at 15, and more like 14. Okay? For the 30-day future. Everyone's happy. Market's doing great. I'm going to be making money. Hallelujah. Well, if you go out the 6-month VIX right now, so I look at the future on the future. This is a third, derivative on a derivative on a derivative. It actually trades at 25. Institutional traders right now, at this moment, are saying, look, whatever the market is doing right now is a farce. In 6 months, we anticipate that the market's going to go through a potential capitulation. QE2 is ending, quantitative easing. Quantitative easing is using a balance sheet to inflate the economy. Fannie Mae can't do it anymore because they're defunct, so we've got another institution that steps into their role. Institutions are not blind to this. Oh, by the way, does this point to market efficiency? Anyone ever watch TV? CNBC? Okay. CNBC, we have a trading floor at the office. And we have our Bloomberg systems, we have various market data systems, and then we have a TV set to CNBC. The volume is turned off. Everything that they put on that screen, I want to know about. Because that tells me exactly what I don't want to do. Anyone watch was it The Daily Show, Jon Stewart? Yeah, his joke, how do you make $1 million in the stock market? Start with $10 million and listen to CNBC. It's interesting if you watch the VIX over the financial crisis and during the course of it, and this is what the problem was. During 2008, the VIX actually, so we go back to 2007, the VIX was actually trading at 10 to 11. It was rock bottom. It really had never been that low. Even if you do back testing on VIX and calculate it. VIX only came out about 4 or 5 years ago, maybe 6. Go back, you really can't find levels below that. 2007, VIX starts to escalate. 2007 was the subprime crisis. That's when CDOs started to fail, collateralized debt obligations. Those are derivatives on mortgages. Bear Stearns starts to fail. Bear Stearns has the alpha fund blow. In 2008, you start to have some really bad things happen. Lehman fails in September. The VIX goes to 80. End of day. Intraday, the VIX goes to 100. Using statistics and econometrics, micro or macro, I don't care what, VIX should never go to 100. This infers that we are seeing a 1 in a 1,000-year event. And then guess what happens? The market, the S&P, moves intraday by 10% on one day. Intraday movements on the S&P rarely ever go above 1. One you can get. 2 is a stretch. 3, 4, 5. 5 is, bad. 10, I want to vomit at that point. And we had days when we literally, I was just like, oh shit, what the hell is going on? Okay, this didn't happen once, it happened 10 times. We had 10 days, intraday movement of 10% on the S&P 500 in a 6-month period. That cannot happen under any classical theory of markets, market equilibrium, perfect information, historical volatilities, indicators of future volatility. No way, never. So what we had between the fall of 2008 and March of 2009 was a market that was reacting in a manner in which no one ever anticipated. That was problem number 1. Okay. Problem 2 is Standard & Poor's. Standard & Poor's and their rating agency assigned a AAA rating to a whole series of instruments that came out of the mortgage market. These were collateralized debt obligations and CDOs squared. CDOs squared, so CDOs on CDOs. The problem is this. These AAA instruments were used by pension funds, by banks, and firms like AIG to shore up their balance sheet, to serve as collateral that they could use to lend money against. Well, as a AAA, they're supposed to never default. Well, guess what happened? They defaulted. Not only did they default, we basically got 20 cents on the dollar for that entire asset class. That literally wiped out 1,000 banks. Right there. Boom, gone. Oh, and by the way, it brought down AIG. They had taken $80 billion of cash collateral. So this is money, this is cash that they're supposed to give back to their customers in a month or 2. And they put it all into CDOs. They now have 20 cents on the dollar. They had a 60 billion, not doing the math right, but they had an enormous shortfall. And that's where the government steps in. The government, unfortunately, is the last of the my triumvirate of issues and problems and mannerisms in which finance today was never anticipated by the theory that we've been using. Very quickly, Hank Paulson told Fannie Mae in May of 2008, go raise more capital. They raised that capital. That capital was in the form of common and preferred stock. The buyers of those issues were banks, pension funds again, institutions that were using it because, guess what? The preferreds were rated AAA and the stock was considered to be the safest stock that you could find. Well, on September 8th, I don't have the dates exactly right, they took over Fannie Mae. Paulson came on TV, he said the common stock is never going to pay a dividend until we can shore up the company. And the preferred will never pay a dividend until we can shore up the company. That will never happen. So those securities went to values of around $25 a share, all the way down to $1. A week later, it's not a coincidence that Lehman Brothers failed. Lehman was sitting on a lot of this stuff. And they used it to shore up their capital as well. From an overarching perspective, to really be able to understand what's going on in the financial crisis, the financial collapse, and to be able to understand our economy going forward, yes, you need micro and macroeconomics, but you really have to put it into the context of technical obsolescence and really the advent of technology in our trading systems today. Behavioral economics, the tendency for people to actually believe and trust. We saw that problem with Madoff. Government intervention. Regulation, that is misguided, regulation that is simply ineffective. And unfortunately, the Frank Dodd bill and act is going to institute a whole series of more crises down the road.
Great, thank you very much. So, two different but related approaches, and we're happy to take some questions, or we can just start with a discussion if there are any questions or comments or thoughts. I mean, one thing I'll say, because it struck me, I laughed, some of you laughed when I laughed, at the VIX, the Black-Scholes, model was developed by physicists and Nobel Prize winners and based on chemistry. I mean, one of the indicators, I think, of the financial crisis was that you had all of these physicists and brilliant Nobel Prize winning people leaving the world of physics and chemistry and engineering and going to Wall Street. And instead of, inventing new products and designing new fundamental research, figuring out ever more abstract models to sort of make more money. And it has to do with this sense that, what I tried to talk about before, well, if you're really smart, what else should you be doing but making a lot of money, right? That's
the capitalist model.
That's where the value is. And I don't mean the money value, but that's where your life worth value is. That's sort of the Weberian argument. And, I think the Black-Scholes model fits perfectly in that. And it's one of the virtues of a BARD, where we talk about a private university and a public service, where we have a whole civic engagement model is, people will go into business as well, but the idea is to really think a lot about these ethical and civically engaged ideas of business and finance, as well as other things to do, and to place a value on that. It was an illustration. I thought that was a wonderful illustration of one of the things that in the lead up to the financial crisis was just mind-boggling to me, was all these brilliant physicists and scientists that were ending up on Wall Street with their own hedge funds.
There's a great anecdote to that. Long-term capital management is a hedge fund that was started in the early 90s by John Merriweather. And he brought on Merton and Scholes. Fisher Black, unfortunately, has passed away. So two of the Nobel laureates. He had a sum total of 100 people that worked for him. And they were somewhat affiliated with MIT, where I did my grad work, so at the time we were pretty close to these folks. He had 99 people who had PhDs. Math, physics, chemistry, all the technical sciences. Very few. I don't think there are only a couple finance PhDs. One MBA at the company. Long-term capital management blew themselves up. They leveraged themselves upwards of 400 to 1. Use the derivatives as a proxy. Their customers were also their backers, the various financial institutions, and Greenspan basically sat everyone down in a room, the CEO of every bank in New York, and said, okay, you created this mess, this company is about to go under, if it goes under, everyone's going to really feel the pain. You solved this. Everyone stayed in the room except one banker, the CEO of Bear Stearns. He got up and left. He said, not mine. The rest of them bailed out long-term capital management. About 12 years later, when Bear Stearns was in trouble and needed help, guess what happened? Everyone said, not my problem. So, goes around, comes around. Great. Speaking to values, though, it's really important to recognize that. Did you have a question? Sorry.
More of a comment, but I don't want to interrupt you. Go ahead.
No, we'd like to bring people into the conversation, so please.
What does that tell you when? Oh, I'm sorry. I am new faculty. Maybe a lot of people have seen some of my students, but my name is Olivia Giovannoni, and I'm in the economics department. what does that tell you when actually you have such a large company called LTCN, which was backed by Nobel Prize winners and plenty of PhDs, who rely all on this chemistry, physics, mathematics, alchemy, maybe for all I know, that failed miserably, and that was 2001, if I'm correct.
A little bit earlier.
Oh, 97 maybe. Yeah. What does that tell you when we have the exact same situation that repeats itself in 2008? Doesn't that mean that the regulators didn't do their job? Doesn't that mean that Black-Scholes formula is deeply flawed? I mean, one usual criticism of this is the constant volatility, for instance, which obviously is not the case for stock market, and you have huge volatility. Black-Scholes formula does not apply anymore, if it applied before. So, I mean, what does that tell you when you have a system called Wall Street generates so much money, which is based on all of this alchemy that doesn't work? Shouldn't that have been a warning in 2097 or for more regulation?
Yeah, I mean, your questions are excellent ones.
Go ahead, you go.
Geithner just made a decision to exclude currencies and currency swaps from Frank Dodd regulations. And he did so for a very simple reason. To regulate that industry would strip a significant amount of profit from the large banks, one in particular, Goldman Sachs. And I don't mean to knock Goldman one particular way or another. They're extremely ruthlessly efficient at what they do. And if it means getting involved in politics, and sort of putting your CEO at the head of Treasury 3, 4, 5 times, they'll do it. I agree. I don't think that, regulation is effective. I think the regulatory environment is frankly just an organ of the financial services industry today. And your comments on Black-Scholes are very well made. It is flawed. Black-Scholes was never intended to work in this environment. It has issues with long-dated options. It has issues with modeling and volatilities.
Are you supporting more regulation? Do I understand you right? Or, I mean, it is well known also that during the financial crisis, it was said that, what was the story? There was only one guy at the SEC in charge of risk appreciation, regulation of risk, that in 2007, 2008, there was only one guy who was supposed to audit the banks on their risky behaviors. If we do not, on the one hand, we have, that's my question, I really wonder, we have this incredible money-making machine, which doesn't exactly know what they are doing, because the major formulas are flawed, the math is flawed. I mean, for all the sophistication there, it's still not perfect. I admire sophistication, but I know that it's still not quite there. And on the other hand, we have regulators who do not want to do their jobs, because partly they are bought because they are part of Goldman.
They don't know how to. This is so far beyond their capabilities.
I think what you're saying is right. I mean, George Soros has written a lot on this. It's sort of one of his, pet issues, which is that, yes, we need more regulation, but the truth is regulators will always fail. And you could ask why that is and what is the complexity. But I think the real issue, and George Soros' argument is that, in a sense, the regulators come to accept the arguments of the regulated industries, right? The regulated industries have a huge incentive in making arguments that this time it's different, that this will work. And in a sense, the regulators often are less well paid, they're not as prestigious, and they buy into it. But I have a slightly, and I think that's largely right, but I have a slightly different view, which is that, I come from law. My background is in law, and if you try and regulate through law some outcome, it usually doesn't work. Why? Because lawyers are very smart people who get paid to do what their clients want to do, and they're very good at getting around the law. And as long as you have a large incentive to make the law do what you want it to do, lawyers will largely find ways to do it. You will never regulate your way to an efficient, to an ethical or a moral or a limited market. As far as I'm concerned, there's only one real way to prevent these kind of crises, which is to take the outsized, supersized incentives out, which would mean to regulate compensation in some way, which is something I don't think you want to do. Some people might, right? But if you were to in some way limit leverage, and in a really efficient way limit leverage, which would be in some way an attempt to limit compensation, that might help. But as long as the potential for unlimited leverage is there, the potential for unlimited risk and speculation is there, I see no way to stop people from figuring out ways to get around regulators and get around laws to do things. I mean, remember, no one at the top of this has been prosecuted.
That's exactly.
And now, you could say that it's a conspiracy, but I think you're wrong. I mean, there's a certain level at which the government has been unwilling to go after people. And I think there's people that probably they could go after. But the bigger issue is this. It's very hard to prove that these people did anything wrong. Because they paid very expensive and powerful lawyers an enormous amount of money to create intricate systems that somehow justify things that all common sense would tell you were wrong. You know, creating 30 shell corporations in tax havens around the world to create new deals and create leverage that was not within this jurisdiction and then not in that jurisdiction, which is how a lot of deals were made. I mean,
Citigroup has 635 legal entities.
yeah. And, you know, Raymond Baker wrote a book called Capitalism's Achilles Heel, which I actually recommend to people, which is a book about legalized tax evasion. But he articulates, or he goes through one particular deal worth, you know, hundreds of billions of dollars with 52 shell corporations that Citigroup put together. All legal. Although common sense tells you deeply unethical. It's all designed to get around the legal framework in a legal way. Well, with that kind of incentive, how are you going to ever write a law that will actually think in advance of all the different ways to stop this from happening? You can't. It's just not possible.
Well, what I have in mind is the legal system. That's I think the core of the issue in here. We have a system that apparently can destroy itself and the rest of the economy. And are you saying that actually we cannot regulate them? Because it's not because it's hard that we shouldn't do it.
Well, you can try, but I think that unless you're willing to take on the incentive issue in some way, you can regulate them, but there will always be ways to get around it. I mean, I don't think regulation can be the answer.
Let me introduce it.
Let Tom come in.
I'd go one step further and say that prosecution isn't even a deterrent. You know, I mean, the incentives are so high. I think you hit the nail on the head with incentives and the leverage issue. You know, Americans like simple things. Focus on leverage. If you look at any crisis dating back to the South Sea bubble, it's all been an issue of leverage in some form. But, you know, people still feel cracked even though the penalties are out there because the incentive structure is there. You know, that's not where we're going to address this. We're going to address this through focusing on leverage ratios, compensation, and then also transparency. When companies can contribute to political systems and buy Goldman Sachs' way into the lawmaking bodies, then that's not democracy. You know, as long as we have this lobbying system that we can't see into, you're never going to get people behind it.
I think this is correct. I mean, I think I didn't make my point clear enough. I think what I believe is that there was always the bubble. I mean, there's no question about this. It looks to me like this crisis is especially a crisis of fraud, of corruption, of absence of regulation.
Okay, but let me push you on this, Olivier. Fraud. Do you mean fraud in a legal sense, or do you mean fraud in a moral sense? Because what's amazing is no prosecutor has found fraud in a legal sense.
Well, the FBI has documented at several places that there was fraud in the financial system.
Where is this stuff? Because no prosecutor has brought a fraud indictment. On low levels, maybe yes, but
An
on a high level.
epidemic of mortgage fraud, as documented by the FBI itself in 2007. There have been plenty of reports about the corruption of the rating agencies.
Yes, but
There have
again,
been
corruption
plenty
and
of
fraud is not
reports
illegal.
of corruption at the corporate level, also, and none of this has been prosecuted. That is true. So one of the things that I found was missing from the discourse that we've had. There was easy money. There was inappropriate tools that we have, and the additional thing that I think is strongly missing in here is the fact that the system is corrupt and it's fraudulent. And it's partly Weber and greed, and I agree only with this.
Can I ask Ton also, and you and David, this question, which is, I mean, one would say it's un-American to regulate incentives, right? The very vibrancy of American economy is we allow unlimited incentives. We don't regulate how much people can make. I'm wondering, Ton, do you think we should regulate incentives?
Yeah, of course I do. I mean, I think that's just ludicrous, you know, and I think that implied in what a lot of you were raising, it's David, right?
Yeah.
Is this dogma that we bought into so heavily, this neoliberal bullshit that, you know, markets are efficient and stand out of the way and it'll take care of itself. You know, I mean, how many times do we need to have crises? How deep do these crises need to be? What does employment have to hit for people to say there's a problem with it? And a huge problem is the incentive structure. If you keep the CEO of Merrill Lynch from earning $400 million as his buyout, he's not going to go to Europe and earn more, you know? And if he does, good for them. Let them crash their economies. But at the end of the day, you know, there's a level to meritocracy. You know, I'm not saying that we should have equal pay for these jobs, but the issue is, you know, it's clearly been a channel of instability.
Can I just ask, I want to get David's opinion on this, but I want to frame it this way.